So this year has not been great for the market, and some major changes have taken place, which have changed how the retirement can take place for normal people like me and you. So this includes the end of the 4% rule. And the inventor himself of the 4% rule has said that it does not work anymore and is not relevant in today's market. So first, what is the 4% rule? Well, the 4% rule is a rule that was made in 1994 in order to help people calculate how much money they need in order to retire. So put simply, the amount that you want to spend a year is 4% of how much you have saved up. That is what it should be. Therefore, you need to multiply however much you want to spend per year times 25. So let's say you thought about it and you realized that I want to be able to spend $100,000 a year in my retirement. Well, that means that you're going to have to do 100,000 times 25, which gives you $2.5 million. So you're going to need $2.5 million in order to retire. That's basically what the rule says in this case, right? So why is this important? Well, millions of people have used this rule in order to calculate how much money they needed to retire. And those people basically rely on this rule for their retirement. However, of course, now it's not relevant. So first of all, how was this rule made? How was it calculated, right? So the inventor analyzed every year of the stock market returns and simulated how much your money would be worth if you retired in each year and lived off those investments for 30 years. So he calculated random years like 1992, 1943, any years like that, and he kept on calculating every single one and got to this number, 4%, right? So, originally this was considered an extremely safe rule and really conservative because, the stock market returns an average of 8 to 9% a year, as you can see right here, and even 10%. And then if we're being safe, it'll be 7 to 8%, right? So this rule is saying you're only going to make 4% a year. So originally it was considered very conservative, but still lots of people used it because when you're thinking retirement, then conservative is what you need to be thinking. So why is it not relevant in today's market? Well, the inventor of the rule says that with sky-high inflation rates, which are 8.5%, which is quite insane, along with the current market conditions, make that rule unreliable. So more reasons is first that while your daily expenses are going to be increasing by 8.5% because of inflation per year, it's going to be extremely difficult to keep up with. And while many will look to the stock market for solutions, they won't get much help, as stocks are considered extremely overvalued right now, and top investment analysts have said that investment returns are expected to decrease in the future. As we can see here in Charles Schwab, their recent analyst chart that they made is that, as you can see, normally we've seen 10% or 9% returns in the past. In this, we can see that they're expecting a basically 6% yearly return in the future for this year and last year. So as we can see, like normally they were expecting for 1970 to now, basically they were expecting 11% a year, and now they're only expecting around 6%, which clearly shows that they're thinking that the market is obviously not going to reap as much of a reward for investors. So for the past generations, basically, they've benefited from steady markets and steady, stable economies. However, the future generations are going to have much more difficulty with higher unemployment rates, lower earnings, and higher taxes in order to pay off the past COVID debts. So it's forecasted that net return of just 3% per year from the stock market is going to be what you're going to get in the future. And that's not accounting for what's going to happen with inflation. So what does this mean for you? Well, you're going to have to think much more conservative when you're planning your retirement. And you're going to have to save much more money in order to get by for the coming years. This also means that these 2 to 3 years will be your last chance to become wealthy before you're swept away by unemployment and crushed by inflation. In order to succeed, you will have to be much riskier investor, and you're gonna have to buy into up and coming growth companies which have the potential to give you returns much better than you would get holding things like index funds. So you will need to be flexible enough to spend only 2 to 3% of your savings some years rather than the advised 4 to 5%. Meaning you're gonna have to be able to get by spending 2 to 3% of your total portfolio. You might want to work a couple more years before retirement to have more options later in life. And this also means that when times are good, you're also going to be able to live lavishly and spend anywhere from 5% to even 10% of your savings per year because the market will be reaping those returns. However, this doesn't mean that it's all over and that you're not going to be able to retire. As we've seen in history, holding long term has always worked and always will. And of course, the market will recover, inflation rates will go down in the future. So this video is not for you to give up hope. This is just to help you stay informed and know that clearly the 4% rule is not what is going to work for today's market, and that you're going to have to be a much more conservative and flexible investor.